1S, and a particularly interesting instrument right here. It's relatively new in the synthetics forum of Deriv, and you know it's quite heavy. It's a heavy instrument in terms of heaviness. I'm talking about if you want to trade these kinds of moves for the kind of volatility that is provided here, you need a substantial amount of equity. You need a certain amount of money to be able to trade. Like, if you're a consistent trader, then this is where you can scale up, right? Your equity. Um, it's not it's not necessarily good for small accounts because the leverage doesn't allow you to do that just yet. But yeah, it is still a fairly new instrument, so which means it's gonna have the same kind of rhythm and pattern as the other instruments that we've already observed previously. So what I'm going to do this time is I'm gonna get you guys through my idea and hypothesis for a trade setup, and basically you guys are gonna take a look at my current narrative has shifted. Initially I was bearish, and I'll tell you why I was bearish, but now the market has actually started to print bullish. It's starting to attack the buy side. So that's very interesting. If you're looking at this candle right here, this week's candle, because we're on the weekly chart, if you see that it's printing bullish, can you see? It's even almost close to overshadowing previous month's week, sorry, previous week's candle. So that one is just above to break. It's just close, very close to the volume, right? Now we're gonna always be dealing with volume, especially for me here as Prince, and you guys need to understand that when I read price action, I don't just use ICT's concepts. I kind of build a narrative around what I'm being told, because when you look at a chart, you need to see a story. If you can't see a story, I'm sorry, but you're not a trader. If you look at a chart, you need to see a story. Now the story is ongoing. There's no end to the story, but you can be a part of the story. You can be part of some of these chapters that the story is going through, and you find ways to be part of that by analyzing, right? So we're gonna analyze together, and I'm gonna take you guys through my process of understanding narrative, institutional order flow, and liquidity. That's just basically it. Those are my three pillars of finding a setup on any time frame. Those are the three pillars that must remain clear and less than ambiguous for me to be able to decipher what it is I'm trying to do. Now, I was initially bearish, guys. I want to tell you this, but uh, yeah, this particular instrument is showing me that it's bullish. Yeah, no, I knew that was bullish, but I was being bearish and I was trading counter trend. But I knew that the initial um, objective for price was above marketplace, so it was bullish, right? It was always bullish. I'll take you guys, I'll break down why I said that it's bullish, and we'll get down into the nitty-gritties. But first I'm gonna remove all of everything that I've marked out here. I'm gonna mark it all out again, starting from the monthly, and then you guys get to see my whole process and get to understand how it is that I actually view price action on these synthetic indices that are offered by Deriv, right? So for me, there's one thing, one note to I need to note this for anybody. Fair value gaps can act as, I don't know, what can I say? Fair value gaps can act as a magnet, but they can also repel price. So they can do the opposite of what a magnet does. They can do that. So y'all need to understand that fair value gaps don't have to get fully mitigated. They only just need to get to, at most, your most likely scenario for any fair value gap getting mitigated is if it comes to at least half of what that fair value gap is, either on the buy side or on the sell side. It is still mitigating by going half of that fair value gap, because institutional order flow will always push for where is price seeking liquidity. If it's seeking liquidity above the highs, then it is it is a bullish institutional order flow. If it's seeking liquidity below the lows, then it's bearish institutional order flow. So there will always be a narrative behind what the market is doing. What you need to understand is how some of these implements or tools that you get to understand after studying ICT, like the fair value gaps, how they function, and then you use them accordingly to the narrative that is being told to you by observing the price chart and by looking at each one of these candles print. It takes a bit of time, but once you get used to it, it just becomes part of your daily routine. All right, cool. Okay, let's get started, guys. So as you can see, I've already marked out. Every time I mark out anything in green, that is usually a fair value gap. So green represents fair value gap. Gray represents order block. All right, so just for you guys, for context, so that you can understand what it is I'm doing. All right, so I'm gonna get rid of everything. Right, I'm gonna get rid of everything that I have on my chart, just like that. Right, and we have a bare naked chart. There's nothing on it. We can only see since its conception on the 26th of January this year. It's a fairly new instrument, I told you guys, right? So as you can see, the price is now currently reversing. As you're just looking at it like this, you can see the price was bearish initially, pushed down to a level, broke below a low, and then it shifted. Market structure shifted here, and now it's starting to print bullish. And I expect that this candle that we're currently printing will probably print another like a bar, just like this one, right? It's gonna be a long candle, right? And that's what I'm anticipating, right? But there's also a consolidation that we're working inside of right here. Above this high and below this low is liquidity. So either liquidity can get taken. I'll explain why I say that. Okay? But this is our bare bones naked chart on the weekly. I'm gonna go to the monthly first so that we can give an idea of context. Remember what I said, narrative building relies on context first. You must have some kind of story that is being overlaid by the price chart, and you need to have it confirmed in all the time frames. I don't care whether you're scalping, I don't care if you're a short-term trader or a swing trader. You need to have your narrative aligned with each one of those time frames that you use, and because you're going to use more than one time frame, even if you're position trading, you're going to need to position yourself properly, right? You don't just get in and just say, get out of 10,000 mos, get that and I have. What are you gonna do? You're gonna blow your account, bro. Right? So each one of these time frames represents a certain level of strength quality that the instrument has in terms of respecting and denying certain areas of interest, POIs, so to speak. But if it gives you narrative is what? Narrative is what is telling you what it's doing at the current moment. It's not necessarily I know the narrative yesterday, so the narrative from yesterday still holds. No, the narrative is ongoing. It's an ongoing because the charts are always open. It's an ongoing process. It's an ongoing communication between you and the chart. So technically, it's a battle between you and yourself. Yeah, right. Your fear and your greed, they get into battle when you're looking at a chart. So this ongoing process of negotiation between fear and greed, you need to be able to stabilize it. You need to make it part of your system such that it doesn't scare you anymore. That you find yourself shifting between those two, corresponding extremes of the human psyche, right? And once you are able to do that, you master your emotions. So there's a lot that goes into just into trading, guys. Into you don't say you're a trader just because you can just spot things easily on the chart. It's also how well you execute, right? So this anchor is refusing to get me anchored on top of this wick, so I'm just going to use boom, just like that. Click it away, right? My music will stop playing, I don't know why, but it will keep coming back, and I hope it's not distracting for some of you guys. So guys, like I said, I'm going to start on the monthly. I'm going to explain to you guys my process. If this inspires anybody, please drop me a comment on the comment section below and let me know that you are inspired and you want me to do more content like this. Leave a like, a sub, to always be subscribed to my content. I bring knowledge. That's all I bring. I'm an ICT. Uh, I accredit most of my trading knowledge to ICT. So I'm an ICT trader. I'm not gonna beat up all the bush. I know that ICT haters out there. I don't know why y'all are hating on him, but that man has saved a lot of lives, basically. And there are a lot of people who are in the trading space who, you know, genuinely care about other people's well-being and are able to assist them in some way. But for me, it's always been Michael. Michael has been my one inspiration. I wanna, especially when it comes to family, he values family more than anything. That's his priority. So that's just the same for me. Alright, so on the monthly chart, guys, I've already marked out my highest high indicated by the wick of this bearish candle here, and the lowest low indicated by the wick of this low candle right here, this bearish candle right here. So that's our highest high, this is our lowest low. So in between that range is our equilibrium. We're gonna find it, boom, right there, equilibrium. We're gonna anchor another horizontal line, different color this time though. We're gonna change the color, and I'm going to change the color to black. Alright, see, I want to say a different color, but let's just go with black because all my other shaded lines, my horizontal lines, are actually in red. I will be paying attention to the equilibrium though, so it doesn't mean that I don't know where equilibrium will be relative to what I've delineated by this horizontal line here. I know. So we have high, we have a low, and then we have a range. And inside of that range, we have equilibrium. And equilibrium is only used in the context of understanding where the PD arrays reside. Right? So the premium PD arrays will always be above equilibrium, and the discount arrays will be below equilibrium. You understand? So I hope everybody's on track now. I hope I'm not losing you because we're just about getting started. On the lower end of the range defined by high and low, that's our discount array. So anything below 50% would be discount. Very, very deep discount. This is where we're getting this bullish momentum here. On anything above 50% is premium. So it's relatively expensive. It's too expensive for price. That's why it keeps dropping and getting cheap, right? So we use those contexts to now give us narration for what is price more likely to be attracted to. And well, when we look at a monthly chart, especially a monthly chart, because the information is so compressed and we only see a month's worth of data compressed in one candle, we assume that that candle is telling us everything we need to know about that particular month in just that whole pass through. So in the side of this candle, there's a fair value gap. Can you not see it? It's right there. I'm going to mark it out so that you guys can see it. From the low of this bullish candle here, this month's candle, first month of this price instrument, its conception, which was on January of this year, there's a fair value gap up to the high of this wick of this month's candle, which was around close to March, probably February, probably the last week of February into March. There's a fair value gap. And right after the break of below the low of the wick of the previous bearish candle, right here, there was still some more sell momentum. So there was still another fair value gap that could be denoted right there. Up to where? Well, we're just going to mark it out. In hindsight, we see what's going on. We can see that this price is already wicking inside of that fair value gap. But before we started printing this for this month, let's look at price from the left, right? There is a fair value gap inside of this huge sell candle right here, this bearish candle right here. The next candle made a pass through, came up to a level, it rebalanced that imbalance, and then it sold. But it didn't close it completely. This is what I'm saying, guys. The fair value gap doesn't need to be completely closed in order to get mitigated. Sometimes this is just enough for price to do what it needs to do before it goes, right? It just touches, just like here, The next candle opened and then it ran up. It rallied for a bit, and then the volume was being kept below the low of the previous candle's low. So there was a rally up, just enough for it to buy before it sold. This is why we don't mock these. These wicks represent a price range, a very balanced price range. And inside of that balanced price range, can you see? What do you see? Equilibrium. It's right there. Inside of that balanced price range, right here. This wick below, the wick above, inside of this candle's range, fair value gap, it leaves it. It falls short of actually coming to 50% of that fair value gap. So that area will act as a magnet, right? We always keep that in mind. But that area is above 50%, which means it's in a premium. So what is the likelihood of price going beyond premium and above 50% to actually come and mitigate that area? It's highly unlikely because it was bearish again initially. There is more bearish prowess in the market inside of this chart than we are currently getting bullish. But we're not saying the price cannot do that. Price is definitely climbing up somewhere. You can see from this previous month's candle it printed bullish, but it didn't completely engulf the previous month's bearish candle. The bearish candle is the one that's engulfing. So it's still stepping, right? So it's attacking these highs. It attacked these highs already, and now it's attacking this high, and it's wicking inside of that fair value gap that we have in that discount area. So it's still in discount. So there's more likelihood for price to keep pumping than it is for it to stop in its tracks and then continue to sell. At this point, nah, that's not the objective. The most likely scenario is for us to come to close in that fair value gap that we still haven't closed. Once we close it in and at least go above and touch that 50%, then when price is allowed to get 50%, then it will be allowed to get, it will probably be at a level where it's allowed to get sold once more. But we will see once we get to that point. So now we understand that we have a narrative. We have an idea that couples with what we're looking for. Price has to get to 50% of the price range, which is that equilibrium that we've marked out with this horizontal line here in black. And once it does that, then there's potential for it to now reverse because it was buying initially. But there's also the effect that after it gets to 50%, it can still deliberate. It can consolidate for a while and decide whether it needs to mitigate this fair value gap up here, which is still a later objective. So we don't worry about that right now because we're on the monthly chart. We don't give too much emphasis on what it might potentially do in the next couple of years. Who knows, right? But this is our projection for now, right? So let's continue to break down the monthly though. We see that price initially had this downward momentum. It broke structure, came back to a level inside of a fair value gap and broke structure once more. It retraced for a bit, went above the high of a previous bearish candle, and then it broke once more. So let's mark out that last break of structure and have it delineated by a different horizontal line altogether. That last break of structure that we get before the price starts to pump like we see it doing now. It's right here, right? It broke structure, right? It also broke structure here, right? It broke structure first here after it went into that. It stabbed inside of the body of that previous bearish candle right here, which is probably around mid-February, mid-January into February, I guess. Crossover into March, it broke structure below that previous month's candle. Then it retraced just for a bit, and then broke structure once more. So this whole candle, after price reverses and changes the narrative and goes on the bullish side, starts attacking the buy side, then we use that idea that we have about auto blocks. Remember what ICD said? Auto blocks are not just the last sell candle before the buy or the last buy candle before the sell. It has to have more context than that. The auto block is the change of state of delivery that is indicated by price action in what it's currently doing. So that star candle that's engulfing this bullish one, that is going to be our order block. So what did I say about order blocks? I marked them out in light gray, just like that. Now we have an order block that is valid. We have another one up here, which is this bullish candle, the first opening of this instrument. We have an order block, so I'm going to mark it out as well just for completeness sake, but I didn't really need to worry about that one because price is still relatively cheap right now and we don't need to worry about premium arrays. And price is now reacting off of that order block, right? It's breaking above highs. So let's mark out our order block threshold with this horizontal line right here. So I'm going to mark it out right there. And when price decided to push above that level, it was instigating that it was now bullish. It was now in a bullish sentiment versus the previously bearish one right here. I'm going to mark out also my breakout structure above these highs. These are relatively equal highs. This one here and this one here. Price breaks above, goes just close near to the previous high of this candle and barely touches it. I mean, it does go above it, but not with volume, as we can see what the current candle is printing. It doesn't do it with bulk. It's just doing it to run out stops. We'll get to see more context as we drop down in the lower time frames, guys. It's a simple thing. So right there, price immediately, you can see there's a reaction because of the wick of this candle, right? So now we have our idea. It's starting to flow, right? We have this current month's candle printing bullish. It's reacting off of that bullish order block, which is that blast down candle before the push up. That's our bullish order block. So let's now get down into the weekly so that we can start to define things more clearly, right? And see what the heck we're trying to look for, right? And we can make sense of what we're looking for, right? So I'm just going to clean up just a little bit. You guys can see what's going on, right? Remember that line that we marked out that comes up to 50%. So let me just change the color of our 50%, maybe to like a brown or a very dark red. Crimson is okay. So we expect that price to want to come back to equilibrium, which is indicated by that horizontal line right here, right? So this is what we're seeing on the weekly, and as you can see on the weekly, you can see the price action is clearly defined. It's clear what is price doing, right? So price here, this fair value gap that we have on the monthly, it starts just here, right here, inside of this consolidation right here. And price initially, when it pushed lower, it allowed itself to retract back to a fair value gap on the sell side imbalance, right? Sell side imbalance, buy side inefficiency. So there wasn't buying. There was only enough buying to get to the level, and then it broke lower than the bearish, sorry, the bullish candle, and then it broke structure to the downside after. So this, it just shows how immense the momentum was to get down to levels. So the pressure is really high here on that fair value gap that we have denoted on the monthly. It starts here, but we can see that on the weekly there are candles that are actually stabbing inside of that fair value gap. So we're going to mark out where in that fair value gap at the lowest end did price starting to have a reaction. Right here, you see how price is sensitive. Look at the wick of this candle. It says now we might be printing bullish, but the pressure is too high. Sell pressure is too much, right? Price break structure with the next candle, next week's candle, the one following, and then another one break structure lower, creating another fair value gap, which is the one that we have here below 50%, the one that's marked in green. It's not the same as this one on the weekly because you can see there are a lot of pass-throughs, so that means price was actually delivered on both sides of the market. So now when price decides to come back into that level, it will find resistance, heavy resistance, because of that. Because what we're seeing interlaid by the monthly, it's a fair value gap, but on the weekly, there's a balanced price range going on inside of that area. So that means when price came to that level, it immediately reacted. This is why we got this bearish candle here. But now the current one that we're printing has went below the previous candle's wick, and now it's printing bullish. So it was running out those stops. Now I'm going to explain why this is important, guys, because this is what's going to give us the narrative that is currently building in my head, the one that I made sense before previously. Price initially came from a bearish stance. It started breaking structure to the downside. It consolidated at a level and then broke structure once more and again. So that gray shaded box that we have here is that auto block that we have on a monthly. But when we look at the weekly, we can also find other auto blocks that exist within it. This one might say it's valid, but I think this one is more valid because this one is the one just before that run into those highs. You see that candle that ran, this is the order block that we pay attention to. So this is our weekly order block that is inside of a monthly order block. So usually what I like to do is I like to mark that one as well, just for context sake. And I usually mark, because we were bullish and we were stepping off of price, so it was like we we're climbing a ladder or the stairs. We use the lowest end of the wick of that candle up to the open of the body of the candle, right? So that's where we consider price to be quite sensitive to any kind of bullishness that might take place once it gets there. So this is where we start to observe. If that order block is invalid, it will get ran through. Okay? I hope everybody's on the same page. Now this one is on the monthly. So this is our weekly order block here. The white one is our weekly order block. It only looks white because it's gray overlaid over gray, right? So now let's look at the extensions of the legs. Here's a consolidation right here. Price then went below consolidation, immediately swept, and then reversed. So there's a change of character right here. Above these highs, it breaks structure. Once it breaks structure, it immediately reacted at that fair value gap. Above that fair value gap, it poked and then swung. It swung, sorry, so to speak. So what we're gonna do, because the setup is quite simple, we don't want to complicate it, we don't want to add too many objects, okay? On the weekly, this is what we're seeing, narrative, right? From the monthly to the weekly, we've already defined the order blocks that exist within where price was predisposed to go higher. So it was quite sensitive when it was at that level for it to get to a particular level above the marketplace. That's why it printed this bullish candle, right? So now the price has the potential to come back to that level again and reinstitute more buying before it buys. That's less than likely right now. Why do I say that? Well, because the momentum has shifted from bearish to bullish. So the same way that they attacked here and then started downplaying, they were still getting down to levels, but they were consolidating. It meant that they were running out of the steam that they were carrying here. So there's a lot of liquidity above these highs. These are old highs, so there will be liquidity resting above those highs, and the market will want to attack that liquidity and take it out. So just like how it attacked these equal highs here with this bullish candle. So now that the narrative is shifted, we must expect price to continue to attack the highs, just as it did when it was attacking these lows. It needs to start attacking the highs with speed, and this is the kind of speed we're looking for, and we got it here. We got just a little bit, and now we're seeing the price with this current week's candle is printing bullish. It's telling us that the speed is also immense on the buy side. There'll be more likely another projection for an attack into those highs, but we would need to get it at least above these highs, because all of this is balanced price range. So this is stiff price action, and it will be, unless price is really willing to get through that stiff price action, it will take time for it to do that. Alright, so this is the weekly. Now look at this price extension leg here from the low of this bearish candle, which is constituting our order block. Inside of that monthly order block, that is our low, and I'm gonna anchor a fib, and we're gonna measure that low to that high, which is the highest high of current price in the bullish institutional order flow. And we can see that price is already stabbed into equilibrium. It ran below this low and then immediately reacted. It's starting to buy, right? So it didn't even close in that favorable gap. Can you see that? If you guys can't see that, I don't know. I don't need to go down into the lower time frame for you guys to see this. You can see it on the weekly. Even it's better you see it on the weekly, so that when you go to the lower time frames, it makes sense. So from this low to this high, this is an extension. This is a leg. It's an impulse from this low price bought, and now it's retracing back in the range, inside of the range. So it retraced to equilibrium. So it came to halfway. Price was allowed to be bought again. That's why we're getting a reaction. In fact, we also took out the low from the previous week. So we're running out some stops at the same time. Okay, so let's take away the fib. So let's understand for Gary. There's a favorable gap there. Ne? It didn't get fully mitigated. It doesn't need to get fully mitigated. It just needs to get a little bit. Yeah, and you get. That's how price moves, guys. Because it has an objective. So if it's going to continue buying, it won't even start now having to come back again to the same level where it's been before it attacked. Get it will only allow just like a little bit of retracement, yeah, before it attacks. So let's change the color of our favorable gap to green. So where are we saying price has mitigated and not mitigated. So once price came into that favorable gap, it ran the low below here and then started to buy, right? So let's define our price range based on the Fibonacci retracement that we just did. So I'm going to extend the horizontal line above the high of that wick. I'm going to extend that. Boom. Inside of the family gap that we see on the monthly here. And then here, this is our low, I get. So let's go down into a day. Re batla go bona gore family gap e mitigate jang gore e be go na le pressure e ntsinyana, the buy pressure that's now currently in play. So go to the daily. You guys can see there's a lot more context behind what's going on. Can you see those lows? That low that we saw here when price came and stepped, you see how it's relatively equal to these lows here as well. So it went and took out 1, 2, 3 lows inside of a favored gap, and then it started to buy. So the momentum is heavy for the buy side. There's more bullish institutional order flow in play. But then again, I could be wrong. This could just be a retracement inside of a range that is consolidating. It could be a consolidation that could span, I don't know, who knows how many days before it decides to buy or sell. Either way, these are volatilities, guys. You have to wait. You need to be patient with them. So here's the daily, guys, and yeah, I'm kind of tired now explaining. It's like when I get to the daily, I can see what I can already see what I'm looking for. Like even if I want to get into a setup, it starts from the daily, guys, for me. Ne? So at this point, because I've already explained most of what we're seeing on a monthly with the weekly, and that's narrative. Right now at this point, I'm just like, hey, yeah. Do I have to explain all of this? This is market structure, guys. You can see it clearly. I don't even need to draw lines. Came from sell side, we broke structure below lows, we swept once more, came into a level, and then we shifted. The narrative shifted. So market structure shift, and then we have a bullish institutional order flow in play. So every time price retraced back to levels, it retraced only to allow certain buys to get into play. So anytime it retraced to certain levels, it bought. So now this is the largest extension leg of a buy that we've ever observed on this particular instrument, V90S. So now that we've retraced, we actually retraced back to I'll think it's equilibrium. So let me just do that for you guys. This low here to this high indicated by this one, equilibrium. We came back to equilibrium. We took out the lows, right? Immediately reversed, right? So we bought. Anybody who's inside of this buy is being profitable right now. You get what I'm saying? But now that's not what I was looking for. Now I was looking for an optimal trade entry. Now, sometimes the market, this is what I want to talk to you guys about today. Sometimes the market will not give you the opportunity to get to optimal trade levels and allow you to get inside. They'll miss you just a little bit, just like how I got missed here. And not even that I was trading counter trend. I was trading inside of these cells. I was like, the price is now retraced back to a premium array here, premium array, a bearish order block, and then it's pressing, so it's going to want to continue pushing lower. Kante, I don't know. It's only suppressing the volume inside of an area to allow just for the sweep inside of that pivot gap before it bought again. You get what I'm saying? Sometimes the trade doesn't give you an opportunity to get in. Yeah, guys, so that's pretty much my analysis for this day. And if you guys are interested to learn more in terms of execution, where I go down to into the lower time frames, like the 4 hour, the 1 hour, 30 minute, 50 minute, whatever the case, and whether you're a swing trader, a short-term trader, or a scalper, there is a unique way to find these setups, and I know how. Just let me know on the comment section, and man, I'll continue releasing content for you guys. So, and until next time, my name is Prince Omari.